Imagine two people sitting in the same bank, applying for the same mortgage. One walks out with a 6.5% interest rate. The other gets 8.9%. Over 30 years, that difference costs the second person over $140,000. The only thing that separates them is 3 digits. So here's the question worth sitting with: what exactly happened in the months before that meeting that made all the difference? Here's why this matters right now. The cost of having bad credit has never been higher. Interest rates are elevated. Lending standards are tighter. And the gap between what a 580 score costs you versus what an 800 score saves you has never been wider. We're talking about car loans, apartment applications, insurance premiums, even job offers in certain industries. Your credit score is not just a number. It is a financial passport, and right now, millions of Americans are traveling on an expired one. If you're sitting somewhere in the 500s or 600s, you didn't get there because you're bad with money. You got there because nobody ever handed you the actual playbook. A medical bill went to collections. You maxed out a card during a rough stretch. You were an authorized user on someone else's disaster. It happens. But here's what the credit bureaus won't tell you, and what most advice columns get completely wrong: the path back is faster than you think, and it follows a very specific sequence. The order of these moves matters just as much as the moves themselves. Let's start with the foundation, because almost everyone skips this and then wonders why nothing is working. You have to pull your actual credit reports before you touch anything else. Not a score estimate from an app. The full reports from all 3 bureaus, Equifax, Experian, and TransUnion, from annualcreditreport.com. Free. Every week if you want them right now due to current policy. Here's a real scenario. A woman named Deja, 31 years old, working in healthcare administration in Atlanta, came in with a 574 score. She had been making on-time payments for 2 years and could not figure out why her score wasn't moving. When she finally pulled all 3 reports, she found a collections account for a gym membership she had canceled in 2019. She never received the notice. It was sitting there, dragging down her score, on 2 of the 3 bureaus. She disputed it, provided her cancellation confirmation, and within 35 days it was removed from both reports. Her score jumped 41 points before she changed a single financial behavior. That is not luck. That is information being used correctly. Errors on credit reports affect roughly 1 in 5 Americans. 1 in 5. Some are minor. Some are catastrophic. A duplicate account showing you owe the same debt twice. An account that belongs to someone with a similar name. A late payment marked incorrectly by a creditor who posted it a day late in their own system. Every single one of these can be disputed, and the bureaus are legally required under the Fair Credit Reporting Act to investigate and respond within 30 days. Start here. This is your first week assignment, and we'll come back to exactly what to do with that in a moment. Once you have clean data, now you move to the lever that controls about 30% of your score, utilization. This is the ratio of your credit card balances to your credit limits, and it is probably the fastest moving variable in your entire score. Most people think paying on time is the biggest factor. It is, but if you're already doing that and your score is stuck, utilization is almost certainly the culprit. Here's the target: get every individual card below 29%. Get your total utilization across all cards below 10% if you can. Not 30. Not 25. 10. That's where the scoring models reward you most aggressively. Marcus, a 38-year-old project manager in Phoenix, had a 601 score. He had 2 credit cards, each carrying about 60% utilization. He wasn't missing payments. He just carried balances. He received a small bonus at work, $4,000, and instead of putting it toward his car, his advisor told him to split it between the 2 cards. He brought both cards under 20% utilization. 63 days later, at the next scoring update cycle, his score moved from 601 to 674. 73 points. From one financial decision. The car loan he took out at 674 saved him roughly $31 per month compared to what he would have paid at 601. Not life-changing on its own, but multiplied across every loan, every rate, every financial product for the next decade? Compounding works in both directions. Now, this is where most people make a critical mistake. They see their score improving and they do one of two things: they open a bunch of new credit cards to increase their available credit, or they close the old cards they don't use anymore because they feel irresponsible having them open. Both of these moves can actually hurt you in the short term. New credit applications create hard inquiries, and each one can knock 3 to 7 points off your score temporarily. Closing old accounts reduces your total available credit, which raises your utilization ratio automatically, even if your balances stay the same. What you actually want to do is use your existing account strategically. If you have an old card you haven't used in a while, put one small recurring charge on it, a streaming subscription, a utility payment, and set up autopay. This keeps the account active without risking a forgotten bill. Your average account age matters to your score, and keeping older accounts alive protects that history. This is the kind of counterintuitive move that separates people who understand credit architecture from people who are just guessing. The third pillar is building new positive history while your existing history stabilizes. If your credit file is thin or damaged, a secured credit card or a credit builder loan is one of the highest leverage tools available to you. A credit builder loan, offered by many credit unions and fintechs, works in reverse from a regular loan. The lender holds the money while you make payments, then releases the funds to you at the end of the term. Every on-time payment gets reported to the bureaus. You're essentially buying a clean payment history with your own money. Keisha, a 29-year-old nurse in Houston, had gone through a bankruptcy 2 years earlier. She opened a credit builder loan for $1,500 and a secured card with a $300 deposit. She treated the secured card like a debit card, charging small purchases and paying the full balance every month before the statement closed. Paying before the statement closes means a lower balance is reported to the bureaus, which keeps utilization low automatically. 12 months later, her score had climbed from 583 to 724. She refinanced her car, dropped her insurance premium, and got approved for an unsecured card with a $2,000 limit. The system is designed to be rebuilt. You just need to know the sequence. Now here's what you actually do this week. Not next month. This week. Day 1, go to annualcreditreport.com and pull all 3 of your credit reports. Read through every account, every remark, every balance listed. Look for anything you don't recognize, any late payment you believe was reported incorrectly, any account that should be closed but shows open, or any balance that doesn't match your records. Write down every discrepancy. Day 2, file disputes directly through each bureau's website for any error you found. Be specific. State the error, state what the correct information is, and attach any documentation you have. Day 3, log into every credit card you currently have and note your balance and your credit limit. Calculate your utilization percentage for each card. If any card is above 29%, make that your first debt payoff target, not the highest interest rate, not the smallest balance. The one dragging your utilization above that threshold. Day 4, look up whether a credit builder loan makes sense for your situation. If your file is thin or has significant damage, this is one of the most efficient tools you can add. Many credit unions offer them for under $25 a month. By day 5, you should have a clear picture of exactly where you stand and a ranked list of the 3 actions most likely to move your score in the next 90 days. This is not about hacks or loopholes. The credit system is a machine, and like any machine, if you understand how it works, you can operate it with precision. 1 year from now, the question isn't whether your score can move from 580 to 800. Thousands of people have done exactly that, with no shortcuts and no magic. The question is whether you're going to have the right information in the right order.